Okay, non-banking financial institutions. By non-banking financial institutions, I mean three types of institutions: uh, microfinance institutions and their regulation, payment services providers and their regulation, and financial leasing uh, businesses and their regulation. I'm not going to look at savings and credit cooperatives in detail, though those are also financial institutions. For some reason, they are not part of the National Bank regulatory mandate. I will not also look in detail about capital market institutions. Uh, Capital market institutions are under development now. Uh, I think the past week there is a proclamation being drafted. I mean, a very early stage about the capital market institutions. I'll look at that probably at the end of this lecture series. So let's look at the three: microfinance, payment service, and financial leasing. First, microfinance. Microfinance regulation. What are microfinances actually? Microfinance are small banks. There's a lot of affinity between microfinance and banks. In many literature, you find that the definition of microfinance simply as a smaller version of a bank. Because of its small nature, because of the small size, means lesser risk to society. The regulations of microfinance are less rigorous than the regulations for banks. The purpose of microfinances is that they are meant to serve the poor and the poorer population and the rural population where banks cannot reach out. Rural, I mean, I think targeting the poor is an important aspect of microfinance businesses than the rural uh, characterization. So we can say even in urban areas, microfinances do businesses and serve society, but they serve the poorer section of the society that cannot access financial services from banks for different reasons. I mean, banks are sophisticated, banks are not appealing to the poor. So, from the regulatory perspective, the types of regulations that apply for or apply to microfinance institutions are both, prudential and non-prudential regulations. So, if you look at the National Bank, directives, list of directives applicable on microfinance institutions, actually there is similarity. There is a kind of mirror. They kind of mirror the regulations or directives applicable to banks with few exceptions. For example, reserve requirement does not have a parallel directive for adapted to the microfinance context, because reserve requirement or reserve directive is primarily a monetary policy instrument, and microfinances do not have or the money supply or the volume of deposit in microfinances is so small that the National Bank does not target that money for regulating monetary situation in the country. Therefore, reserve requirement does not apply to microfinances. Corporate governance directive also does not have a parallel in microfinance context, because National Bank is not that much worried about corporate governance, or so it seems. That's why we don't have those types of regulations. Otherwise, more or less, directives for banking business and directives for microfinance are parallel in terms of their development, but the ones for microfinance are less rigorous, less cumbersome. So you have entry regulations, therefore, in microfinance. Entry regulations, minimum capital, fitness and proprietary of officers, directors, CEOs. But again, less burdensome compared to the regulation of these aspects in the banking context. We also have, as an entry regulation, we have minimum capital requirements, which currently stands at 10 million BIL. I'll come back to the distortion this creates in relation to achievement of financial inclusion policy of the country. In relation to investment, microfinance are regulated differently from banks, because microfinance proclamation and the regulations allow the directives microfinance allow microfinance actually to engage in different businesses. So microfinance can do savings, credit, insurance, financial leasing, investment advisory, payment services. They can do everything. In a way, microfinance are like universal banks. Universal bank in many other countries, they have different types of financial services integration. A universal bank is one type. A universal bank means a bank that does everything, every financial services. Insurance, banking, investment, capital market participation, leasing, and what have you. There are also different types of integrations, like financial conglomerates, for example. Different subsidiary companies focusing on banking, insurance, leasing, investment, coming under one holding company, which creates the conglomerate. Ethiopia does not allow that type of integration. Ethiopia requires, as part of its financial sector regulation policy, Ethiopia requires that banks should be separate, independent from non-banking institutions. So if you do a banking business, you don't do insurance, you don't do leasing, you don't do, investment advisory and so on. If you are insurance, you don't do others. But at the microfinance level, that's allowed. The microfinance can be at the smaller level, at the micro level, it can be a universal bank. That's what you find when you look at the proclamation and the investment directive in microfinance businesses. A different directive for microfinances is this interest rate cap. The National Bank applies interest rate cap for microfinances. They cannot charge as much interest as they require on the credit that they give. And this is said to create contradictions or anomalies on the business of microfinance, because microfinance business is very difficult compared to banks, because the loan or the loan portfolio of microfinance is very diffuse. They give smaller loans to thousands of individuals, whereas banks give few big loans. That has its own risks in terms of risk distribution. That's why we saw single borrower limit. But on the other hand, in the extreme, if you give smaller loans to thousands of people, then collection will be very expensive. Now, microfinance, because they give smaller loans to widely scattered borrowers, collection is very difficult for them. So part of the factors taken into account in charging or calculating interest rate is the cost of collecting loans. So in this context, therefore, introducing interest caps for microfinance seems to be unfair. When banks are free to fix interest rates on loans, it's unfair to require microfinances or to impose caps on microfinance interest rates, because microfinance require even more freedom than banks in terms of determining interest rates. But the other argument in favor of interest cap for microfinances, because the type of society served by microfinance is the poor. So without interest rate cap, it's very difficult to serve the poor. So microfinance may end up inaccessible for the poor if they can charge high interest rates. So there has to be some kind of balance where microfinance are allowed to be profitable and at the same time serve the society. With this minimum capital for microfinances, which currently stands at 10 million, but there is a problem, because the policy towards microfinances is skewed in Ethiopia. If the intention is to serve the rural population, the poor population, where banks are not interested to expand, then that can best be achieved through fragmentation of microfinance businesses throughout the country. Currently, we have about 35 microfinance businesses in the country. That seems to be a very small number. If Ethiopia truly desires to achieve financial inclusion, where microfinance are accessible at each and every Warada and Kabale, then we need to have thousands of microfinance. If that is a policy, then 10 million, minimum capital of 10 million for entry is a very high threshold. If people have 10 million, if an investor has 10 million, why do you get into microfinance and serve poor people in the rural part of the country, while you can set up an import-export company and make money so fast? So there needs to be kind of rationalization. Why do we need the microfinance, and what is the objective of regulating microfinances? What is the need for the high minimum capital, like 10 million? It seems to be very high. On the other hand, from the National Bank perspective, if you have thousands of microfinances, then you are not going to be able to regulate them effectively. You are not going to impose prudential regulation. You are not going to impose scrutinize fitness and propriety of officers. You are not going to look at the weekly, monthly reports generated from thousands and implement effective control. It's going to be very cumbersome. So the easy way is just to have a limited number of microfinances, but that, on the other hand, compromises the objective of financial inclusion, making microfinance accessible to the deepest part of the country. So a solution may be some kind of delegated regulation. There's a lot of similarity between microfinance and credit and savings institutions. But the credit and savings institutions are about 20,000 in Ethiopia, a very huge number. If the National Bank is required to regulate them, well, that's out of the question. Who regulates credit and savings institutions, or savings and credit cooperatives rather? Who regulates them is the Federal Cooperatives Agency. It really does a nice job, fairly speaking. So in the future, it may be considered that microfinance regulation is delegated to this cooperative agency with some kind of capacity building, and the National Bank actually takes its hands off this sector. But the National Bank may have to cooperate, I mean, with cooperatives agency by developing standards, prudential requirements, while the actual monitoring and implementation is handled by uh, the, the cooperative agency. So if we have to have a sound practical financial inclusion in the country, then this may be the policy way forward. With this, let's go to payment service business and the